Hi, this is JC Parets with allstarcharts.com, and today we are looking at U.S. Treasury bonds. Our vehicle of choice in order to analyze how Treasury bonds are behaving is TLT, which represents the longer end of the curve. It's one of the more popular and liquid vehicles to trade Treasury bonds. Here we're looking at a weekly candlestick chart, which takes us back to where the big rally from last year originally got started, when sentiment was at historic bearish levels coming into 2014. Economists were pounding the table that interest rates were going higher, and therefore it was time to sell Treasury bonds. This is right here, and they could not have been more wrong. In fact, everything was telling us that it was time to be buying Treasury bonds. So not only did interest rates not go higher, they actually had one of the worst years in the history of U.S. Treasury bonds, which goes back several hundred years. Here's the monster rally that we got in 2014, and here's the correction. So we've come down to exactly 61.8% of that entire rally, and this is a major support level. It also represented support back in early 2013. So this is the key level. From a tactical perspective, although we're looking at this longer term, from a tactical perspective, I see no reason to be long if prices are below this level. This is our key level. Looking at a little bit more short term, this 115.5 level is exactly what we were just watching. This is just a daily candlestick chart. Here's that support that we were just referring to. I also included another level of overhead supply that I think is important to recognize. Number one, in last August, we had an island reversal that created a brief correction before the next leg higher, and that level also represented key support throughout the month of November. And that, look how tight these candlesticks are, and look how tight this range is. And from these really tight ranges, you generally get explosive moves upon a resolution. In this case, is to the upside. But I think it would be irresponsible of us not to at least be aware that this key support is an important one. And sure enough, during this entire range throughout June and early July, this has served as resistance as well. Not just this overhead supply that was former support in the fourth quarter, but also this downtrend line from the highs in April. I think this is a key level. Price target wise, I think we definitely break out above that and heads towards 123, which were the highs at the end of May. This is the target. We run into this bigger downtrend line. We have a flat 200-day moving average. Also key support from both December and early March that represented resistance in May. I think that's where we're headed. I think we get above 23. So longs, we do not want to be long above this, and we want to be adding two longs only if we're above this downtrend line from the April highs, and we want to be taking profits as we approach this overhead supply near 123. That's what we want to be fading into.